Well, next up, we'll discuss budgeting and spending plans. But first, let's take a look at how one family has gained control of their personal finances.
Sure, thank you.
Like many families today, the economic crunch has made it difficult for Craig and Jennifer Monson to stretch their dollar.
Craig will tell me we don't have enough money to do this or to do that. It's hard to see where exactly is the money going every day. Hi, guys.
With Jennifer staying at home with the children, Craig, a software engineer, has been the primary breadwinner of the family. But recently, he was forced to take a pay cut in order to keep his job.
We're struggling, we're just kind of going month to month. The burden comes from seeing that we're not making any progress. That's the really heavy weight. Hi, how are you?
To help the Monsons feel a greater sense of control over their financial future, A Place of Our Own has brought in financial coach Julie Staub to offer them guidance.
When we think about a couple and we think about putting two lives together, we naturally assume that everything is going to be happily ever after, and that's really where it all begins.
It's like there's something that's squeezing us somewhere, but I'm just not sure exactly where that squeeze is happening, and I don't quite know how to get it to stop.
We're just treading water is essentially what we're doing right now.
When you feel out of control like this, usually you're missing one of two ingredients, or both. One is information, and the other one is action. Do you know the interest rates that the credit cards are charging you?
Yeah, they're all about 30%.
It is cheaper for a credit card company to lower your interest rate than it is to get a new client. On average, if you owe $1,000 on a credit card and you pay the minimum, it will take you 16 years to pay it off. If you add $10 a month, it will take you 4.
After going through the Monsons' credit card debt, monthly expenses, and spending habits, Julie discovers the true source of their financial difficulties.
I have a much stronger sense of what's happening with our finances than she does, but she spends the money.
Can you hear the disconnect? That you pay the bills, but Jennifer spends the money. She needs to know what's going on over there.
I've tried to explain how much money we have and where it's going. I mean, I think I saw one of the printouts is essentially the list that I have sent her before. That's what I've put together. And
that's the thing right there. It's what I've put together. Mm-hmm. And sometimes I just feel like don't get me wrong, but sometimes I just feel like, you're the breadwinner of the family, and here's what our bills are, and I'm taking care of it. There's just a manner in which that it's kind of presented as just this is the way it has to be, and I just don't necessarily always feel like I'm part of the process.
I find that the basic financial challenges of the Monsons is they've been so busy, each one taking care of their own world. They're two circles rather than converging in the middle and really just communicating.
To open the lines of communication and help Craig and Jennifer create their family budget as a unified team, Julie suggests the couple have a monthly money night.
The money night is a time that you set with your partner to talk about money, nothing else.
So we still might actually get a little bit.
Yeah.
Okay, well, that's good.
And it makes you look at each other and deal with it rather than it running your life.
To actually schedule time, have a date that you talk about money, it feels good to look at each other and go, okay, we're going to talk about this. We're going to move forward together. Yeah. Where is this guy? Show me.
Craig and Jennifer realize that together they have what it takes to face the challenges that lie ahead.
I'm very confident that now we can work together as a team as opposed to opposing forces and really get focused on fixing this particular problem in our lives.
I want my children to have a positive relationship with money. I want us to break whatever cycle we're in. Julie made us feel hopeful, and it was exciting because I just had this feeling like finally we're going to make this big, bold step toward a solution.
With a solid budget and a renewed sense of optimism, the Monsons are working together to make better financial choices, and in the process are becoming a stronger and happier family.
Can you rock
the daddy chair?
Back. Our guest for this segment is David Hansen, Executive Director of a nonprofit organization that promotes wise personal money management. David is a certified public accountant and has spent several years working with individuals and families, helping them with personal budgeting and tax matters. So if you have a question for David or you would like to speak to any of our specialists that are manning our phone bank tonight, don't forget to call the toll-free number. It's 1-800-298-5298. Now, David, welcome to Economic Sense. You know, in that last segment, we discussed the role of family relationships in money management, and I'm sure you've seen this, but how do personal finances affect our personal relationships, especially within families?
It's so interesting because when I'll sit down with a family, it almost becomes immediately apparent where they are in the relationship because the problems they're having so often are founded on the way they communicate. Now, certainly we're going to talk about skills and tools and things like that, but the foundation is exactly what Dr. Israelson was saying, in that if people aren't talking with each other, it's like two ships in the night just going by each other. You may have one spouse who is really worried about saving and planning for the future. Another spouse may be wanting to enjoy the moment and purchasing things and that. Well, if they're not talking about those two things, they're on a collision course or passing in the night like those two ships, because their goals are different and they're doing different things with their money, and it just exacerbates the problems that they have in their finances.
Well, and especially when you talk about troubling times and economic recessions and all, it starts to magnify, we use that term again, our fears and our concerns about will money be there for me next month or next year or in my retirement, and it kind of raises the stakes of these financial differences between the husband and the wife.
Oh, it really does, and if they're not talking about it, they tend to entrench. One will spend more or do more in that sense, another will try to hoard more, and then they start resenting what the other person is doing, and it makes the problems worse. Conversely, if a family's willing to sit down and talk, if they can get on the same wavelength, respecting, as was talked in the last segment, that they each have values that are important. They may differ from each other, but they're still important, and they can come to a meeting of minds on going forward together. Then they can make progress. They can start to learn together the tools they need to know in order to be successful in managing their money.
Okay, I like that. You're different, I'm different, but we want to move forward together on this.
Exactly.
So let's be practical. So where do we go from there?
Well, you need to get the tools. So you lay that foundation of communication. Once you're doing that, then you need knowledge. You need to know how to manage your money. You know, it's really interesting. We go to lots of training, we go to college and that. We get very little training on how to manage our personal finances. I'm a CPA. I went through years of college training, advanced degrees. Not once did I have a class in personal finance. It's amazing.
Well, I know in the state of Utah, we just started to put that in our high school curriculum.
We have.
Which is essential, but we're 2010.
You know, it's interesting, only 3 states have that requirement. Utah is actually one of the leading states in that, and we still have a long ways to go in standardizing curriculum and getting that information out. So we want to start by giving people the tools they need to be successful. So once we get those tools, then the next step is to actually use those. And we can wrap this up in what we call a budget cycle, basically. We want people to first identify where they are, find out where they are, know their income, know their expenses.
Right, know what your situation is. Okay.
Then second, we're going to help them develop a plan so they know what to do given their circumstances, and that's where the tools come into play, and we'll talk about that as we go forward. Then the important step, and this is where a lot of us break down in, we actually have to do something with those tools that we've been given, and that requires an ongoing effort on our part, on the part of the person exercising this budget plan.
I liked what you're saying, and you said it not only requires the knowledge, but also the willingness to do something about it. Because even if we take the classes, even if we sit down, we have to have that commitment to put it in action. Huh?
It's so interesting. The studies that we have done have shown that one of the major breakdowns, first is a lack of knowledge. People just don't know what to do with their money.
Right.
The second is not doing anything with the knowledge they've been given. And they say, wow, that's a great idea. You know, people listening to this program tonight say, well, those are some good ideas. But if they don't do anything with it, it doesn't do them any good.
All right, well, we're going to tap into some of the tools that you're presenting to us, but we do have a call.
Great.
We've got Mike who is calling in, and Mike has a question about budgeting. Mike, thank you so much for calling us.
Hi, Mike.
Hey, hi.
Hi, what's your question?
My question kind of goes along those lines. I mean, me and my wife, we've kind of looked at our assets and where our money's coming from and kind of where it's going. And we've tried various budgets in the past. And I wouldn't say they've been too rigid, but we how do you feel this all out? Like, how do you start off with a budget? Like, you kind of know the tools, you kind of know what you're supposed to do. It doesn't work the first time, so how do you keep on refining that process? How do you take your knowledge and some of the tools and start putting it forward into a working budget that can be evolved into the budget you actually use?
Right. So it sounds like his system wasn't really effective at first. So what's your advice? Thanks again, Mike, for calling.
Thank you, Mike. And what you've described is a problem that so many of us face, and that is getting into a process that really works for us. There are a lot of budgeting plans and models that are out there that people try and use and then kind of fall away from. One model that works very well, and many experts recommend, is something called envelope budgeting. It comes from back in the days of the Depression, before we had credit cards and checks and things like that. People got paid in cash.
Sure.
And they'd sit down, just like Dr. Iselson was saying with that example, they would sit down with their cash, their real money, beginning of the month, and they'd actually set out some envelopes, one for rent, one for groceries, one for maybe entertainment, and they would allocate their money to those different envelopes. Then during the month, they would use that envelope, say groceries, they'd pick up their grocery envelope, they'd go to the store, and they'd spend out of that. Now, a couple important things come out of this. One, they've allocated their money so they know where it's going. They also know that they can't overspend what they've got in that grocery bill because the other money's got other assignments to do, to pay the rent or to do other things. And as they go through the month, they can look in the envelope, they know how much they have left.
Okay.
Well, that was good in a cash-based society. Now today we've got credit cards and checkbooks and cashless transactions.
Electronic payments, et cetera. Sure.
It's really hard. But the amazing thing is the principles, you can call that fund accounting, that's what we accountants would call that, or envelope budgeting is a common term for it. The principles there are the same. You still need to build a spending plan. You need to set up at the beginning of the month and identify what things do I need to spend my money on. Rent, groceries, your gasoline expenses.
Right.
Don't want to forget savings, and we can talk about that a little bit, but a savings allocation. Future vacation, starting to set money aside for future things.
Repairs, medical, sure.
And this is where two spouses, it's important. They may have different ideas about what's important or where they want their money to go. They've got to be communicating. They've got to be working together. So they collaboratively identify the categories, and then you take the amount of money that you're going to have, not your gross income, but the net amount of income you actually have to spend. And that's an important something to understand.
Sure.
We all get a gross amount that we're paid, but we want to work with the net income that we actually get the check that we're going to put in the bank and use. We're going to allocate that at the beginning of the month to these different categories, and then we track our spending against each of those categories. And that's the key thing. There's two key things there. One is making the decision to allocate your money.
Sure.
And then the second is spending against those allocations.
And then, I guess, evaluating at the end of the month, saying, all right, well, we didn't estimate correctly in these envelopes, and then making adjustments and moving forward. And I like what he's saying. It didn't work before. We're going to try something new and keep moving forward. We do have a call.
Great.
Dean is on the line from Spanish Fork. And Dean, I'm glad you're called. Welcome to Economic Sense. How can we help you?
Well, my question is, whenever I've tried to make a spending plan in the past, it's these expenses that don't come every month that throw me off, or birthdays or weddings or things like that I know they're out there, but I don't know when they're coming, and I don't know how to prepare for them.
Well, great question.
It's
Thank
a
you,
great
Dean.
question, Dean, and that is one of the real bugaboos that people deal with in budgeting. But if you do an envelope budgeting, one of the things you're doing is looking forward. So part of your planning is to stop and think, okay, what is in the future that I need to start looking forward? And initially you may miss some things, but once you start getting in this mode of planning ahead, you start thinking, okay, car insurance is a classic one, comes up every 6 months, you know that's going to come up. Family vacation. How often does suddenly, you're 2 weeks out from the family vacation, there's no money, so you use credit cards and you're racking up debt. Starting in January, if I know I'm going to go on vacation in August, that's what my family does, we can start in August and allocate a certain amount of money each month, and we set that aside in savings. Again, in those fictitious envelopes I'm putting out on the table, I have an envelope or a category, then I'm going to set aside money in January for that amount. And it builds up each month, so by the time I get to August and I go on that family vacation, I've already paid for it. I don't have to use the credit cards for it, or the extra debt. You may use the credit cards, but that's a different matter there. You have to start looking into the future, and that's the key, is starting to plan. And Dean, that is a challenge, but once you start thinking about it, once you get in that mode, then you start to realize, okay, the insurance, that Christmas is another great one, planning for gifts, things along that line. Savings,
car repairs, deductibles. You get in a car accident, next thing you know, you're out $500. I've been told, too, that if you look back over the last year and you're able to take a look at last year's finances, you can typically project some of those miscellaneous.
Looking backwards is a good way to get an idea of what's coming ahead. But you don't want to get too trapped by looking backwards, because that's in the past. What's important is what's coming up. And even if you're in debt and got some challenges now, it's what's coming up that's important.
Well, and interestingly enough, because you bring that point up, what's coming up, there are warning signs.
Absolutely.
To financial trouble. And very often we are not aware of what those warning signs are. So in just a bit, we're going to talk a little bit more about financial strain. But first, we want to make sure that we understand the red flags that do signal financial trouble. So here is a short video that can help you determine your financial situation and then notice whether or not you are in financial trouble.
Job loss, ballooning mortgage payments, medical bills, there are many factors that can place families in financial jeopardy. Some people don't even realize how close they are to disaster. There are several warning signs that signal you may be towing the line between monetary stability and instability. Do you constantly worry or think about money? Are you using your credit card to purchase basic necessities or items you paid cash for in the past? Do you or someone you love hide expenses from the family? Are your credit card balances continually increasing or at their limit? Can you pay all your bills on time, or do you have to decide which you'll pay now and which you'll pay later? If you answered yes to any of these questions, you could be on the path to a serious financial problem. Here are some important steps you can take to avert economic disaster.
We got to get a handle on these.
Yeah, I know. The first and most important thing is to talk with your family and determine what your financial goals are. Write them down and refer back to them as you make decisions. These goals are the standard by which you'll determine where to allocate your resources.
All right. Any other ideas?
Second, take an inventory of your cash flow. Gather your pay stubs, checkbooks, bank statements, credit card bills, and other financial documents. Don't forget to include periodic expenses like taxes, insurance payments, membership fees, and home and car repairs. Then, total your income and expenses and see how they compare. You could be spending more than you are bringing in without even knowing it. This may seem simple, but if you are spending more than you make and using credit cards to pay for necessities, you will need to come up with a different strategy. You may never know for sure until you see it in black and white. If there are expenses you can't identify, it may be helpful to track your spending for a few weeks. Frequent small cash purchases can account for a big portion of your spending.
Take this notebook and write this down.
Next, compare income to expenses to determine whether you need to adjust spending habits in order to meet your goals. The Utah State University Extension Service offers research-based resources on personal and family finance, along with many other topics. Help is available by logging on to extension.usu.edu/Utah and clicking on Family Finances. There you will find a self-directed tutorial and sample budgets to help you determine where your family stands.
Oh, that's wonderful.
Many private firms, credit unions, banks, and credit card issuers also offer their customers help in tracking their expenses. But what about those who are struggling to stay afloat? If you need more than a family meeting to straighten out financial troubles, there is help by calling 211 Information and Referral. This lifeline can save you from sinking further into an economic whirlpool. By evaluating, watching, and controlling your budget, you will be able to direct your money to the best place to help you reach your financial goals. Help and resources are available through government and community-based services and are just a phone call or a mouse click away. Call 211 to speak to a specialist in your area or log on to kbyutv.org/economic sense for links to numerous organizations that are in place to render assistance. Whether your budget is large or small, whether you need a little help or a lot, remember, it's okay to ask.
Warning signs, really important from there, what to watch for. And I know that you work a lot with different people in different situations. But once you know what your current situation is, what is that next step to take?
Well, it goes back to what our first caller says. You need to build a budget, or what I'll call a spending plan, because really what you want to do is take control of your money. You want to basically manage your money instead of let it manage you. So you're going to build a spending plan looking forward to identify what expenses are coming up for you in the given period, usually a month. So let's call our month our spending period. We want to build a plan for this coming month. So I'm going to identify my fixed expenses, things like rent, cable bill, maybe your cell phone bill,
mortgage payments,
mortgage
rent,
payment,
sure.
those things like that. Your variable expenses. These would be things that you have to spend, but you have some control over. Groceries, you can be really extravagant, or you can be,
or like Dean said, birthdays, and a birthday could be a $20 gift, or it could be $200, depending on your expectations.
Exactly.
Sure.
So things like that. Entertainment is a good example. Maybe your hobbies, things that you want to spend money on, but you can control what you do there. And then there's the thing that our other caller talked about, the periodic expenses, the things that don't happen every month, but you need to plan for them because they are going to come. And if you start planning for them now, if you turn them into a monthly or periodic expense, then you're prepared for them when they come up.
Okay, you say that. So annually, some people will pay, for example, their property taxes once a year on their own. So rather than being hit by that $800 or $1,200 bill once a year, would we open up a separate savings account where we push money into, and we have multiple savings accounts for those?
You could do that, but it's just as easy to have one savings account. But what you do is in your budget plan, let's take Christmas. Christmas, everybody deals with Christmas, and they're going to spend, let's say you have a plan of $1,200 is what you're going to spend on your gifts and purchases.
It's going to be a great gift. I can't wait to see what you get me.
Well, there's other people too. Sorry, not just you. But I know that I need to have that money, and if December comes up, I'm going to use credit cards if I haven't set that aside. But if I start in January and save $100, I put that in savings, it's set aside. I'm not going to spend it because I've allocated it towards my Christmas budget. February comes, another $100, but now I've got $200 built up. By the time you get to December, you've saved the $1,200. Now, the second part of this is you have that $1,200, you need to exercise the fiscal discipline to only spend that $1,200. You can't go and spend $1,500. Now, you could spend less and then use that money for other things.
It goes back to knowing what you need to do and then doing what you need to do.
Exactly.
We've got a call. It's Jenny from Orem.
Hi,
so
Jenny.
We're curious to see what your question is. Jenny, thank you for calling Economic Sense. How can we help?
I was just wondering, what is a good computer budgeting system or a website that I can go to that can help?
Well, you know, Jenny, there are a lot of different programs out there. What you first need to do is identify what you want to accomplish and what you're comfortable with. There are package packages that you can buy. There are online packages. There are also free packages. You can also do traditional paper-based systems. I'm not in a position to really recommend one or the other. What you want to identify is the system you want to use. Many programs use common ledger-based systems, similar to an electronic checkbook. The envelope budgeting system I talked about, where you're setting up categories, there are systems available online that can do that. What you need to do is identify what you want to accomplish, how you want to do it, and then go out and read the reviews, do some search on the internet, or talk to some experts and find out what they're recommending, and then find what works for you. And if you're like me, you may try one or two different things before you find the system that really works best for you.
Great. And she also asked about an online resource. And don't forget that we have kbyutv.org/economic sense, which will guide you as well. We've got another caller in right now who's calling in, I believe, from Salt Lake City. Hi, and welcome to Economic Sense.
Hi, thank you. My question is, with paying off credit cards and trying to get my credit cards paid off, how do I actually fit that into my monthly plan for my budget or my monthly spending plan? How do I do that?
So you're trying to more aggressively pay off those credit cards, and she wants to make sure it's part of her budget, or monthly budget or spending plan. Great question.
That is a fantastic question. Credit cards can be a great tool or they can be the devil's playhouse. They can really get people into trouble. I personally believe that it's a tool, and it's learning to use them responsibly that makes them a great tool that people can use in actually managing their money. What you want to do is recognize first and foremost that a credit card is not new money. Go back to when we were setting up our budget, we identified that we have X amount of dollars each month that comes in that's real income. Your credit card doesn't add to that. It's just a way to spend that money. So
that credit line is not your real cash.
It's not your real
Right,
cash.
sure.
In fact, you don't want it to be a credit line because then you're creating debt that's going to add to future expenditures that you're going to have to pay. So the way you do it is if you use your credit card, that purchase, let's say you go and buy groceries.
Right.
And you're going to spend $50 on groceries. That $50 comes out of your grocery budget. But that money, you haven't actually spent it yet. The credit card is a pending expense. So that money comes out of the grocery budget and it goes into your envelope, your category, to pay the credit card bill when it comes due. So every time you make a purchase, you take the money that you've allocated, whether it's, let's say, gasoline purchase next. I go to the gasoline, the
If I pay
service
with my
station,
credit card, I take cash out of my envelope.
or on your budget that you've
Okay,
written down,
right.
transfer it into the budget to a pending credit card payment. Then at the end of the month, what you've done is the money you've allocated to your different expense categories, you've tracked it, you've controlled it because you've kept track of your groceries, your gas expenditures, but that money is moved over now to the envelope or to the category to then pay that credit card bill. Then at the end of the month, when the credit card bill comes due, the money's already there to pay for it.
Well, and we have some points that you put together
Yes,
about
yes.
managing credit
Let me
cards.
look at
and,
that.
and it's interesting because you said credit cards can be very good.
Absolutely.
Not just bad. Not looking at them as additional cash, treating the credit card purchases as deductions against your monthly income,
Yes.
which is what you were just mentioning, and then paying off the monthly credit cards at the end of...
At the end of the period. In fact, there's another slide. If we can go to that, it's got it titled Managing Credit Cards. And if we look at that, if they can pull that up, and then we'll see if they can bring that up. But what we show is that what you're going to do is you don't want to spend any extra money beyond your income. So you take each of your purchases, you're going to keep track of those, take them out of the individual categories. That money gets transferred into that separate category to pay off the credit card.
There's that additional
There it is there. So
information.
let's look at that then. So as you see there on your screen, I start out, you can see there's my different grocery purchases that are coming out there. The purchases are getting added together, as you see there, and then at the end of the month, I've got a total of $510.35 there that I've accrued in credit cards.
Okay.
But that money has come out of my grocery budget because I set that money aside there. But now, because I made each one of those purchases, I took it out of the grocery budget and put it into the pay the credit card budget. So the money's now sitting there ready to pay the credit card because that was the money I set aside to use to do that.
So by doing that, you're using your true cash on hand
Exactly.
without borrowing from the banks.
Exactly.
Therefore, you're not getting into the debt situation, even though you're still using a
Right.
credit card.
Now you notice here too, some people are carrying a balance on their credit cards. So when you build your spending plan at the beginning of the month, you're going to plan in a payment against your minimum budget, maybe a little more so you can start paying it down. So that starts out in your credit card budget already, that minimum payment. In this example that we just saw up, it was $42. So that's there. Then these additional monies come in. So at the end of the month, you've got your minimum payment, plus all the money that you spent from your current income set aside, ready to pay that. And maybe you've allocated some additional money to keep paying down that balance you're out there. And if you do that, not only are you not accruing new debt, you're paying down your old debt and getting into a position where you're debt-free and your credit card becomes a real tool for you in tracking your money.
And I've got to admit, that's probably the very first time I've ever thought of using that credit card as a tool to utilize current cash that I already have on hand, but it helps me with the tracking of my expenses. I want to remind everyone, too, that if you want to call, you are welcome to do it, just like those who have been calling in tonight. We can answer your questions. It's a toll-free number at 1-800-298-5298. Any question is okay. If you have advice to pass on, you can do that as well, and we welcome you on Economic Sense. We've had a lot of turmoil when it comes to the financial crisis we've been in, and I know that as you've been working with individuals, everything has been probably couched in that sense. I might have lost my job, or I'm concerned about my investments because of. What type of advice are you giving for us right now?
It starts with communication. Again, going back to the idea that you have to talk. When something happens, you lose a job, maybe a major medical comes up, whatever the issue is, you can't stick your head in the sand and ignore it. You've got to be pretty upfront that we've suddenly had a major change in things. What happens so often is people just keep spending money the way they have been, even though maybe they have lost their job, or they have suddenly a huge additional expense that's come into their life. So you need to talk about, identify it, and then you need to build a new plan that incorporates this new change. If you've lost your job, boy, you're going into a mode where you want to cut back your expenses everywhere across the board. And that requires some honest, tough communication. Oh, maybe we've got to reduce the cable channel or even do away with it. Groceries, we're going to cut that down. Eating out, boy, that's going to go away or be severely curtailed. All of these variable expenses we're going to just reduce down as much as possible, as soon as possible. Now, I want to preface something here. We're talking about this. For those who aren't in crisis right now, we don't know what the future is going to hold. One of the first things we always counsel people to begin doing is to start paying themselves, meaning start saving money now for a rainy day, long-term for retirement, and then for short-term emergencies that may come up. Standard rule of thumb, if you're a single income household, you want to have 6 months of income set aside in savings to be prepared for the unexpected.
6 months of savings.
6 months of saving of what your net spendable income would be. That's your goal. Some people are going, wow, where am I going to come up with that? You know, even if you're setting aside just $5 or $10 a month, that builds up quickly, and it's amazing. You know, lose a tire, you got to buy a $100 tire. Well, if you've got $100, then that's not a big deal. Or, I mean, you can deal with it. It is a big deal. So you start saving now. It's just a few dollars a month, build it up to more.
And that would be, I guess, as we're looking at this graphic right now, under emergency savings. So 3 months of income in 2 income homes. You said for a 1 income home, it would be 6 months of income. A little bit easier maybe to put that aside. But that gives you that peace of mind when we're in a financial crisis, whether or not you've lost your job or not. You know, I'm okay. I'm going to be okay for the next big long-term savings.
It's interesting. Financial experts generally will say of the money you're saving, you want to do a 60-20-20 rule. So you take 60% of your income and allocate it for long-term savings, retirement. 20% is that emergency fund that you're building up. And 20%, you might call it mad money. You might call it planning for the unexpected fun things that you want to do and being ready to do those things. And again, some people are going, wow, things are so tight. All I can set aside is $10 or $20. That's okay. Start with that. Set that aside. If you do 2 things, build a spending plan, take control of your money now. Stop spending more than what you have coming in. Make those allocations. Plan, decide up front how much money you're going to allocate to each thing, then track it during the month against what you've spent. Just those envelopes we talked about at the beginning, you're spending out of that. And include some savings. Very soon you can start to pay down your debt. You've started to build up some savings to take care of the emergencies that come up. You have peace of mind. You're in control of your money instead of being driven by these debts and expenses and things that are coming at you.
I love that. You're managing your money, not your money managing us.
Absolutely.
Thank you so much. You've been very, very helpful for us.
Economic Sense is made possible by contributing viewers of KBYU and by the Utah Housing Coalition, Community Action Services and Food Bank, and Utah State University Extension.